And even more importantly, there are some underlying indications that 2013 is going to be better yet, largely because we are seeing some very strong signs of a rebound in the housing market. I am reasonably bullish on the economy, just like I was last year. If I had to sit down and take an investment position, the answer would be strongly long. In the meantime, there are some hopeful signs. Outstanding C&I loans are coming up. Supply managers in September finally see the ISM above 50. Looks like things are kind of in neutral mode right now, and they probably will be until we're through the election. And again, we finally figure out this whole budget thing. Unfortunately, despite all these issues at the federal level, state, local governments are still going to get squeezed. Not so much because their revenues aren't rising, because they have all sorts of automatic increases in spending, and federal support's going away very rapidly. So this part of the economy will, unless we decide to raise taxes, again, Prop 30, Prop 38, your choice. But if we don't pull that particular lever, government's going to continue to be a drag. If we do, it will be less of a drag. That's everybody's put a particular decision on that. But again, understand the consequences of that choice, whether or not you're for or against it. In the meantime, what about the markets? Should we expect a giant collapse in the stock market? Well, I don't know. I mean, predicting the stock market is a fool's game. I will say this. Yes, it is true that corporate profit growth is slowing. But then again, corporate profit growth is higher than it's ever been. 25% higher than it was pre-recession. Higher as a percent of GDP than it's been any time in the last 30 years. And of course, a lot of the increase in profits is coming from overseas. And with an overseas weak economy, particularly Europe, you knew that was going to take a bit of a hit. But here's a more important point. What does that mean for the stock market? We know PE ratios are high. Doesn't that mean the PE ratios start backing off? We start seeing a big dump in the market? Well, here's probably the best thing I can tell you. Right-hand side here, this is the spread of equities over treasuries. This is your expected return in equities, that is to say PE ratios looking at N plus dividends, relative to treasuries. And they haven't been this high, the spreads haven't been this high for 30 years. What that means is, even with corporate profits slowing down a little bit, your best place to put your money is still equities. It's still equities. It's where you want to be. So add it up, because we're at the end. California U.S. economy is on the mend. I continue to be bullish. They're going to come out with the GDP numbers tomorrow. It's going to be probably 2.1%. There's going to be mad spitting on both sides of the debate. Ignore it all, because none of it means a pile of beans. Q4 will likely be a little higher than that, probably in the 2.4 to 2.5%. And as long as nobody pushes it off the track, we could get up in the 3% range, maybe a little higher next year. Things are getting better. You're sitting in the middle of it. And in the meantime, you got great food, great wine, and a World Series game to watch. So quit your whining and enjoy. Thank you very much.